Welcome to the March 2026 edition of Let's Talk Markets. As always, our goal is to educate, inform, and empower the families and businesses we serve. And so if you find today's discussion valuable, we encourage you to share it with others who might benefit from staying connected to what's happening in the markets and why it matters. And so this month, I want to start with one word that explains a lot of what we've seen so far in 2026. And that word is rotation. Because if you haven't been looking under the hood of the market lately, you might have missed what's really been happening. Now, at the headline level, the returns you've seen, they've been choppy, right? And so for the week ending March 13th, 2026, last week, the S&P 500 was down about 2.86% year to date. NASDAQ was down almost 5% at 4.77%, and the Dow was down 2.75% year to date. But what's most important, it's not just the index. It's what's underneath it. Take a look at this. Sector leadership has flipped. And as you can see on this first chart, sector dispersion has been stunning. Earlier this month, energy was up 27.6% year to date, while areas like tech and consumer discretionary and financials, they were negative. And just to show you how quickly this has continued to evolve, in our most recent week ending data through March 13th, energy's up that 29% year to date. Consumer staples are up almost 10.5%. Utilities up 10% as well. But look at the laggards. Financials down almost 11%. Consumer discretionary stocks down 7.9%. And tech, everybody's darling of the last couple of years, down 6.6% year to date. Now, here's the important context. If we rewind to 2025, this picture would have looked completely different. Last year, a much smaller group of leaders, especially around the mega cap growth stocks, did a lot of the heavy lifting. And this year, leadership has moved to a different part of the market. That's what rotation is. And we've talked about this. Growth versus value tells you the same story. Look at this second chart. Earlier this month, large cap value was up, while growth was down. And from the start of this year to the end of last week, you can see the same theme in the numbers. The Russell 1000 growth, down 7.3% year to date. The Russell 1000 value, up 2%. And again, that's a meaningful contrast to the last few years. In 2023, 2024, and 2025, growth-heavy areas were often the headline leaders. So far in 2026, the script completely flipped. And we had talked about that in previous Let's Talk Markets. Even the former leaders are lagging. Look at this third chart. It's the one that really drives the point home. As you can see, the Magnificent Seven, right? The names that have dominated so much of the conversation over the last few years were all down year to date as of early March. That's rotation in real time. The takeaway, what worked yesterday doesn't automatically work tomorrow. And this is exactly why we believe in being proactive in the markets and never complacent. Rotations happen, leadership changes, narratives shift. And if you've watched our Let's Talk Markets over the last several months, you've heard us talk about what a disciplined approach actually looks like. Remember, process over prediction, diversification, rebalancing with purpose. That discipline is what prepares portfolios for environments like this, instead of reacting after the fact. All right, with that set up, let's jump into this month's Ryan's Market Fact, because it helps add some additional context to the market's reaction to the recent developments relating to oil and Iran. So take a look at this. This is global oil production. And as you can see on this chart, the U.S. is the world's largest oil producer. In 2024, the U.S. produced about 22.8 million barrels per day of petroleum and other liquids. That's roughly 22% of global output. Saudi Arabia and Russia were next at about 10.9 and 10.5 million barrels per day. All this information comes from the U.S. Information Administration. Now, if you look at Iran's production, it matters, but it's not the whole story. For some perspective, Iran produced roughly 4.6 million barrels per day in 2024, making it the world's sixth largest producer. Now, the real oil lever is the Strait of Hormuz. It's a major choke point for global energy flows, and you've heard a lot about this in the media over the last couple of weeks. In 2025, about 20.9 million barrels per day moved through that strait. Roughly 20% of global petroleum liquid consumption and about 1/4 of globally traded maritime oil. It's a big deal. So when you hear Iran and oil in the same headline, markets aren't just watching one country's production. They're pricing the risk to global energy flows and what that could mean for inflation and growth and the broader market. So, all right, with that oil backdrop, let's zoom out a little bit and let's talk about what markets tend to do during geopolitical shocks like this. And what can history tell us and what it doesn't? So, our big discussion today, Iran, oil, and what markets tend to do during wars. Now, if you've been watching the headlines the last couple of weeks, you've probably are thinking some version of how does this end? And what does this mean for the stock markets or markets in general? And that's the right question. And the honest answer is, we don't know how it ends. Nobody does. But we can explain what the market is reacting to, why leadership has shifted, and what history can and cannot tell us. So here's what we're going to do in this segment. First of all, we're going to talk about why oil is the main transmission mechanism from this conflict into markets. Second, we're going to highlight what the market is actually pricing: uncertainty, inflation risk, rates. Then we're going to put the moment in perspective using two charts that do a great job of framing wars and stock market returns. And then we're going to land on the takeaway. That takeaway is discipline beats reaction. So first off, why oil is the lens the market is looking through right now. In conflicts like this, markets don't react to every headline equally. They react to the variable that can change the economic math the fastest. And right now, that variable is oil. Oil is one of the most important inputs in the global economy. It doesn't just fuel cars, it fuels transportation, shipping, manufacturing, and the movement of all goods. So when oil prices move sharply higher, it has ripple effects almost immediately. Here's why that matters. For consumers, a higher gas price functions like a tax. More dollars go to the pump, and that can mean fewer dollars left for discretionary spending. What about for businesses? Fuel and transportation costs rise. Think about airlines, shipping, and logistics, and any company moving physical goods can see higher costs show up quickly. That pressure can work its way into their margins. What about inflation? Higher energy prices can lift inflation expectations, and that's one of the fastest ways the interest rate outlook gets repriced. And this is why the Strait of Hormuz keeps coming up. A meaningful share of global oil flows through that narrow corridor. So any disruption isn't just a regional headline. It becomes a global supply and price issue. Take a look at this. As economist Brian Westbury framed it, roughly 20 million barrels per day typically move through that strait. And oil moved from roughly $65 per barrel pre-conflict towards $100 shortly after. And you can see that repricing on the oil chart, right? Brent surged back above 100 with the chart showing roughly $108 on March the 9th. Whew. Bottom line, markets are watching oil because it's the clearest transmission mechanism from geopolitics into inflation, interest rates, and corporate earnings. So why the market is pricing uncertainty, inflation risk, and rates? Well, because once oil starts moving like this, the market isn't just pricing the conflict, the war. It's pricing the second and third order effects. In the short run, uncertainty isn't about what happened yesterday. It's about what happens next. Questions like, how long does this last? Does it widen regionally? How long are key shipping routes disrupted? What does that mean for oil and gasoline prices, and for how long? Those questions matter because oil can hit the long-term drivers we talk about on Let's Talk Markets all the time. They hit on earnings and they hit on interest rates. So how on earnings? Higher energy costs can pressure margins. Fuel-heavy industries like airlines and shipping, they feel it directly. And many other companies feel it indirectly through higher transportation and input costs. What about interest rates? If oil and gasoline stay elevated long enough to push inflation expectations higher, it can make rate cuts less likely or push them further out, even if the market expects rates to drift lower over time. That path deepens on inflation continuing to cool. So when you see big day-to-day moves, it's not just headline whiplash. It's the markets trying to constantly reprice one central question. And what's that central question? Does this stay a contained geopolitical event, or does it become an inflation and rates event that changes the economic outlook? And that's where we're at today. So let's look from a chart perspective standpoint. Wars look chaotic in the moment. No question about it as it relates to the market. But this is where charts are so helpful. And as you can see on this first chart, S&P 500 total returns, the growth of $1 from January 1941 to March 2026. The market's long-term trend is up. We all know this. Even though that line is littered with major conflicts and geopolitical shocks, $1 became $12,746 over that span. It's amazing when you look at it from that perspective. And that doesn't mean wars are good for markets. That's not what I'm saying. It means something more practical. The world often looks chaotic in real time, but when markets tend to be resilient when viewed over long periods of time, and that's what we've seen. So kind of another chart perspective, there's no typical outcome, but time has tended to help. As you can see on this second chart, this is the S&P 500 total returns following the start of U.S. military conflicts, and the outcomes vary widely in the short run. Some conflicts had negative 6-month or 1-year results. Others were strongly positive. But what's interesting is what happens as time extends. Look at that on the bottom, the average total return across the table. Plus 7% at 6 months, plus 11% at 1 year, plus 46% at 3 years. What about 5 years? We'll try plus 94%. Looks even crazier when you go plus 10. 10 years, 227%, and at 20 years, 685%. This is exactly the nuance we want to communicate here. No, history doesn't give us a clean script for what happens next. But yes, history suggests that over time, markets have often moved higher because wars end and the economy and earnings tend to grow over long stretches, even if the short run is impaired. So, what's the takeaway here? The bottom line we're going to leave you with. This is an oil-driven story for markets. Hormuz disruption is the pressure point because it feeds directly into inflation and rate expectations. Second point here is the short run is uncertainty. And what have I always said? The markets hate uncertainty. That's why volatility is elevated and why leadership can rotate quickly. And third, the long run is still earnings. That's what it's about, and economic growth. History doesn't promise smooth markets, but it does show that markets have proven resilient with enough time. And if you've watched Let's Talk Markets for a while now, you've heard us come back to the same disciplined investing outline over and over again. What is it? It's process over prediction. It's diversification. And it's rebalancing with purpose. This is exactly the type of environment where that matters most. Because leadership can change fast and concentrated portfolios can get exposed when the winning areas shift, just kind of like what we're starting to see right now and what we've been calling for some time. And that's a perfect lead-in as to why we offer our second opinion service. When the market changes and the world gets noisy, it can be valuable to step back and make sure risk is balanced. The portfolio isn't unintentionally over-concentrated, and every position has a clear purpose. We've seen firsthand how helpful this perspective has been for friends, family, and clients, and we'd be honored to offer that same second look if it would be useful to you. Okay, so a lot of data, a lot of information during that point, but I want to get into our closing segment here, and it's about seasonality. And I thought this was kind of a fun way to end things today, but I want to talk a little bit about the Grinch Meal. And so just know we're so grateful that you joined us today, and we encourage you to share the content with anyone who might benefit from staying connected to what's happening in the markets and why it matters. But as I said before, and before we wrap up, I want to leave you with one more reminder of something we've continued to highlight here on Let's Talk Markets lately, right? And it's that seasonality and well-timed marketing. It can create real, measurable business results, right? So what did I talk about? The Grinch Meal? Well, last month we talked about Valentine's Day spending, y'all remember? And before that, we had the pumpkin spice economy. And this month's seasonality in action might be my favorite one yet. You ready for this? It's the Grinch Meal. Is it silly or is it a success? Yes, this is a real thing. McDonald's ran a holiday promotion called the Grinch Meal. It came with a Big Mac or a 10-piece nugget meal, plus dill pickle Grinch salt shaker fries. And instead of a toy, it included Grinch-themed socks. These are amazing socks, by the way. And I looked about getting these after this meal was done. On eBay, you're getting like 4 of these things for like $150. So everybody wants these socks. But why in the world are we talking about the Grinch in March? Well, in the markets, we have to wait for quarterly earnings to get an update on how a company has been performing. And so finally, McDonald's Q4 2025 earnings call was February 11th, 2026. The CFO, Ian Borden, said the Grinch Meal set new sales records, including the highest single sales day in company history, and that they sold nearly as many Grinch meals as their 2025 Minecraft movie meal and 2024 Collector Cups promotions combined. And then it got even more insane here. On that same call, McDonald's said that with the Grinch collectible socks, which are the coolest things ever, they were the largest seller of socks in the world for nearly a week and sold about 50 million pairs globally in the first few days of the campaign. You got to let me know if you picked any of these up. I want to know, and I got to see pictures. And that's the punchline from an investing standpoint. Silly little seasonal promotions aren't just silly. They actually drive traffic, they drive engagement, and they show up in quarterly results, which is exactly why economists, analysts, and investors watch these kinds of consumer signals. So I hope you enjoyed that. Something that I thought was pretty interesting. And as I've said before, we have the replays of all of our Let's Talk Markets posted on our YouTube channel. And if you haven't checked it out yet, you definitely got to. It's also home to our Beaver Nuggets and our podcast, Between the Bears and the Bulls. And I'm telling you, we cannot wait to share with you our conversation with some amazing guests coming up. It's going to be so much fun. So please be on the lookout for our emails announcing the release of our upcoming episodes. And as always, if you have any suggestions on what you'd like to see from us, please let us know. We want to make sure that the content that we put out there is valuable for you. All right. So last thing I'll leave you with St. Paddy's Day being yesterday, I had this question. Why is it not a good idea to borrow money from a leprechaun? It's because they're always a little bit short. We'll see you in April for the next edition of Let's Talk Markets. And don't forget, leave it to Beavers.